Welcome to Peak Oil News for June 24th, 2022.
We know exactly who the oil companies, what the oil companies pay attention to, what is their number one priority: profits. And so think about it this way. If this were just ordinary inflation, we might see prices go up. But prices at the pump have gone up. Why? Well, let me give you a hint. Chevron, Exxon have doubled their profits. This isn't about inflation. This is about price gouging for these guys. So I get it. When we see prices go up, we're all concerned, and the Republicans want to come in and just try to hammer on one theme about this economy. But we got to pay attention to the fact that folks like the oil companies say, I think it's just another opportunity to make profits, and we need to call them out on that.
Oil companies have been some of the favorite targets in the blame game played by politicians regarding higher prices. Particularly leftist politicians have enjoyed pointing the finger at oil companies, who have admittedly made large profits over the last 18 months. However, it seems to be lost on most of those spouting this angry rhetoric that U.S. oil companies saw negative growth in 2014, 2016, and 2020, and likely feel that they must store up some fat for the next famine. That seems likely as a recession looms over the horizon. Before we go into the concept I'd like to explain, I want to ask you, why does a one-number bet in roulette pay out so much higher than a single hand of blackjack? I think you would say likely that it is because the chances of winning in roulette on one given hand or one given bet are much lower than the chances of winning on one given hand in blackjack, and so the payout is greater. In finance and economics, this phenomenon is called the risk curve, meaning the greater the risk, the greater the reward must be. Okay, so with that simple concept behind us, let's look at oil profits today, and let's just do some back of the napkin math and compare the 1950s to 2022. For at first glance, you might agree with Warren. In Saudi Arabia, the break-even price of oil was just under 10 cents a barrel, and oil companies would sell it on the open market for roughly $1.20. So they would make $1.10 per barrel. Let's see what they make today. According to most research, the break-even price for Aramco is about $45 per barrel. And currently today, oil is sitting at about $107 a barrel. That means that major oil players are getting about $62 per barrel. Way more, of course. Now, to be fair, let's price adjust for inflation. I'm going to go here to my handy inflation adjuster, and you'll see that 110 in 1953 is about $11.50 in today's currency. So $1.10 in 1953 would buy you about as much as $11.50 today. So far, it's still a score for Elizabeth Warren. They are making tons of money. But now let's consider risk, because this is a business venture and it does have to deal with risk. In 1953, price volatility. What if there was a crisis? Let's say it's the Cold War and there's some sort of, showdown over a dam or something like this. The price of oil drops by 60%. Well, a 60% drop from $1.20 would leave them with a 48 cents in which they could sell that barrel of oil for. And remember, it still only costs 10 cents to make or produce. So they still have an ROI of 38 cents. Not bad. All right, so they're still clearly profitable at 300% or so. Now compare that to what would happen if you were at 107 and you lost 60%. Well, what you'll see is that the price of a barrel of oil goes from 107 down to $42. That would be below their production price. So they will be operating in the red. And of course, a company that stays in the red is going to make its investors very unhappy quite quickly. So in short, investors and oil companies must go further and further out the risk curve in order to make money. And if capital is to be attracted to such a dangerous investment, it will need to get compensated. After all, would you play roulette if it only paid out like blackjack? And look at oil price action since 2008. This is really interesting to me. We see these types of severe drawdowns time and time again. And in fact, the volatility since 2004 is pretty stupendous. And I'd like to remind everybody that one of the signatures that the peak oil prophets told us would happen was that at the peak of oil production, we would start to see massive price volatility. Well, that seems to be really clear what this chart is showing us. For certainly after 2004, volatility has gone through the roof. Okay, that's all I had today. I just wanted to kind of explain that concept. Take care and be safe.